It's been a long recovery, but now the US jobs market has improved substantially. Consumer spending's up, and growth in the second quarter reached 3.7%.
Our baseline is for the Fed to hike in September, and that assumes that market panic will calm down. If we see continued fear in markets, then there certainly is a risk to our baseline that the Fed might want to delay that to October or December. It's a less likely scenario.
But New York Federal Reserve Chairman William Dudley says the chances of a September rate hike may be less compelling if recent global turbulence impacts the US economic outlook. Some economists think the Fed will simply wait and see.
The Fed should certainly not raise interest rates right now. That would really be throwing oil on a fire, that they should wait to see things calm down.
Central banks around the world have been lowering rates and purchasing additional assets through quantitative easing, policies to stimulate growth. That generally makes the US dollar stronger and US exports less competitive.
The strengthening of the dollar, the oil prices falling, commodity prices falling, all of that is pushing inflation into an even lower level. So there's no real rush for the Fed to start normalizing interest rates.
The Fed wants its preferred measure of inflation to be around 2%, but newly released data shows it came in at just 0.3% in July.
Inflation may become an important factor in this decision because Fed Chair Janet Yellen has said that in order to raise rates, officials need to see continuing improvements in the jobs market and inflation moving towards its 2% target. Daniel Ryntjes, CCTV, Washington.